In this video, we're going to be talking about debit vertical spreads. Now, they're kind of like the opposite of the credit vertical spread, and that's a strategy that I talked about previously. You can check it out in a video over here. Before we can go any further, I need to first state that the debit vertical spread is not an option selling strategy, but it is a simple and effective strategy, and the principles behind it form the basic foundation upon which we can build more complex option strategies. Things like calendar spreads, ratio spreads, zebras. In order to get to the fun, complex stuff, we have to start by building a good, solid foundation. So let's begin. So a debit vertical spread is an option strategy that is made up of two option positions. We will buy an option contract with a strike price that is very, very close to the current market price. And at the same time, we will sell an out of the money option contract with a strike price that is further away from the current market price. Both of these option contracts will have the same expiration dates. Now, there are two types of debit vertical spreads, and I'm going to illustrate them using two examples. But bear in mind that these two examples were specifically selected just to illustrate how the strategy works, and it's not in any way meant to be taken as investment advice. Alright, so the first example, this is at C as of June 18, 2021. Now let's say I've done my research and I think that the stock price is going to rebound from this 160 support line and also this trend line. But maybe I don't think that it will be a very big price movement because I see this 220 resistance line, which I think could cause the prices to consolidate. And the time frame for this to play out, maybe around 3 months. So I want to find a way that I can benefit from this potential move, but with a limited amount of risk. In case I'm wrong, I want to know exactly how much money I could lose, and I don't want to lose any more than that. What I can do is I can buy a call option with a strike price of $165 with 3 months to expiration, and this will cost me $1,900. Theoretically, if the stock price increases to infinity over the next 3 months, my gains are unlimited. But if I'm wrong and the stock prices fall, my losses are limited to the $1,900 that I paid. Now, since I know that the chances of making infinite returns in the next 3 months is very, very unlikely, by trading options, I can actually give up the chance to make infinite returns in exchange for lower risk on this trade. How can I do that? What I will do is sell a call option with a strike price of $220 with the same 3 months to expiration. And for selling this call option, I will receive a premium of $350. So I paid $1,900 to buy the $165 call option, and I will receive $350 to sell the 220 call option. So all in all, my net cash outlay for this trade becomes $1,650. And that means that my maximum risk on my trade is now reduced to $1,650. If I'm correct and the stock price increases to $220 and above in the next 3 months, the effect of these two option positions is that I have the right to buy the shares at $165 and I have the obligation to sell the shares at $220. So that gives me a profit of $5,500. So if we deduct the $1,650 net amount that I paid for this option position, the maximum gain on this trade is $3,850. If I'm wrong and the share price is below $165 in 3 months, I'll make the maximum loss of $1,650. This debit vertical spread that we see here is known as a bull call spread. It's made up of two call options. We buy a call option that is close to the current stock price, and at the same time, we will sell an out of the money call option with a strike price that is higher than the current stock price. Let's see what happens to this trade. In this case, I was correct. By the expiration date in September 2021, the share price has increased above $220. Therefore, I made the maximum gain of $3,850. In this scenario, the stock price moved by 30%. But by utilizing a bull call spread, I was able to make a 230% return. We can see here how using a bull call spread is a much more efficient use of capital. It enables us to make a much higher percentage return, and at the same time, we can limit our risk. The second example, we're looking at Zoom on July 16 of 2021. Clearly, we see that the stock is in a downtrend. Maybe I think that this downtrend is going to continue. The stock price is going to fall to the 280 support line in the next 3 to 4 months. In this case, I could execute a debit vertical spread known as a bear put spread. This strategy is made up of two put options. In this example, I buy a put option with a strike price of $360, 4 months to expiration, and this put option will cost me $3,500. At the same time, I will sell a put option with a strike price of $280, also 4 months to expiration. And for selling this option, I will collect the premium of $800. Cumulatively, I will pay $2,700 for this bear put spread. So if I'm correct and the share price does fall and it falls below $280 in the next 4 months, then I'm obligated to buy the shares at $280. But I also have the rights to sell the share for $360. So all in all, that gives me a profit of $8,000. Then we deduct the cost of the bear put spread, which was $2,700. My maximum gain on this trade is $5,300. If I'm wrong and the share price increases above $360, then I will incur the maximum loss, which is the amount that I paid for the bear put spread, which is $2,700. In this particular example, the trade played out the way I expected, so I risk $2,700 to make $5,300, and that gives me a 200% return. There we have it. These are the basics of debit vertical spreads. Made up of two option contracts. We buy one that is close to the current market price, and we sell an out of the money option contract that is further away from the current market price. We use a bull call spread if we are confident that share prices are going to increase, and we use a bear put spread if we are confident that share prices are going to decrease. Debit vertical spreads are efficient ways to deploy capital. Also, they give us the benefits of being limited risk. We know exactly how much we're going to lose if we are wrong and how much we're going to make if we are correct. However, there are some considerations that we need to pay attention to when we trade debit vertical spreads. I'm going to talk about two of them. The first consideration is that when we trade debit vertical spreads, time decay is not in our favor. In fact, time decay is going to work against us. So if you're going to trade debit vertical spreads, make sure that you have enough time to expiration, at least 3 to 4 months of life in the option. And bear in mind that the closer and closer the option contracts get to their expiration date, the time decay is really going to start accelerating, and the option contracts are going to lose value really quickly. So this is something that we need to pay very close attention to. The second consideration is that debit vertical spreads cannot be rolled. In this video, I talk about how we can roll credit vertical spreads to give ourselves more time to be correct and even collect more money in the process. But rolling does not work on debit vertical spreads. We cannot increase the time to be correct and expect to make more money at the same time. If we're wrong, we're definitely going to be losing money. So we have to make sure we are very confident in our price movement predictions before we execute debit vertical spreads. Now personally, I don't use debit vertical spreads because I prefer to use option selling strategies that helps me to benefit from time decay and volatility contraction. Now if you're new here, you can find some of these option selling strategies that I've already made videos about on this channel. I'll link some of these videos in the description below. As we go along, I'm going to expand on the things that we've learned today about the debit vertical spread. And we're going to see how these principles are at work in more complex options trading strategies. You don't want to miss out on that, so make sure you are subscribed. Now that's it for today's video. Like, comment, subscribe if you found it to be helpful, and I will see you in the next video.